Most South African investors are missing this, and it's quietly costing them millions. In this video, I will show you 6 due diligence traps that most investors never check. And if you fall for even one, it could cost you millions. One of these traps cost a South African investor over 500,000 rand, and I'll show you which one in a minute. But if you stay till the end, you'll be way ahead of the pack. By the way, I'm Ekow. I'm a property investor, a legacy builder, and a former investment banker. I made my first million in property investing without using a single cent of my own money. It changed my life, and now I teach others how to do the same. And before we dive in, let me tell you this. Every property deal hinges on 3 pillars: physical, financial, and legal due diligence. Ignore even one and you are investing blind. Let's break down the 6 traps investors miss, starting with something nobody talks about. Trap number 1, check walkability. How walkable is your property? You might think that doesn't matter. But in 2025, tenants want convenience. I once bought a property in Midrand, gorgeous unit, but tenants kept leaving. Why? Shops and transport were a mission. If this is your first rental, tenant turnover will eat your profit alive, and it usually starts with location complaint. Even just a mere 10% drop in occupancy from poor walkability can slash your net profit by thousands monthly. Let's say your 1.5 million rand rental brings in 15,000 rand a month. Now, watch what happens if you lose just 10% occupancy. That's 1,500 rand a month, 18,000 rand a year, and 180,000 rand gone over 10 years, just because tenant didn't like the walkability. Use Google Street View before buying. It's free and it's game changing. If you want help reviewing your next deal or just a second pair of eyes before you sign, book your free consultation at propertyaskeko.com. Alright, here's another one that caught one of my students off guard. Most people never see it coming until the units stay empty month after month. Trap 2, check cell signal in the building. Imagine signing a lease and realizing you can't even take a phone call inside the house. It happened to one of my students. She had to walk down the street just to call a plumber. As a first-time landlord, the last thing you want is to lose tenant over something you didn't even think to check. Before you sign, check your reception. Inside, every room, every floor. Low signal means low retention. If even 2 tenants leave because they can't make a call from the lounge, that's 15,000 rand a month gone. Now, if it takes 2 months to replace them, that's 30,000 rand gone. Add marketing and admin fees, and that's over 32,000 rand gone because you didn't check the cell signal. If you've made it this far, you're already ahead of most buyers. Hit that like button, share this with your WhatsApp group or investor circles, or that one friend who is house hunting right now. This might be the most expensive mistake they never saw coming. Alright, let's look at something that's invisible until transfer day. Trap 3, property taxes after purchase. You found the perfect deal. The numbers work until they don't. In South Africa, once you buy, the property gets reassessed, and then bam, rates skyrocket. Always ask your attorney to calculate post-transfer rates. One investor in Pretoria taxed rent up 3 times overnight. Your cash flow might look perfect on paper until that first municipal bill hits you like a brick. Let's say the seller is paying 3,000 rand per month in rates. After transfer, the council reassesses it and you are hit with 9,000 rand per month. That's 6,000 rand more every single month. Multiply that by 12, you are losing 72,000 rand a year. That's how cash flow disappears and why most great deals turn ugly real fast. And if the rising interest rates don't get you, your own numbers might. Trap 4, stress test your cash flow. The spreadsheet looks great. You are earning 12,000 rand a month. Tenants are happy, but what if something shifts? Interest rates rise, tenants leave, maintenance spikes. Suddenly, you are down 15% on rent and 2 units are empty. That's why we stress test. If your numbers collapse under pressure, walk away before you bleed out. Let's say your deal earns 12,000 rand a month. Drop rent by 15%. Now you're at 10,200. Now take on 20% vacancy. That's almost 3 months with no rent. Now you are bleeding over 24,000 rand a year. I learned this the hard way. My first 8-unit deal, I didn't stress test it. That deal nearly took me out. First-time buyers tend to fall in love with the deal, but forget to ask, what if things go wrong? Most investors never check this. That's why we stress test. Because if you don't plan for storms, you drown in them. That's how we sleep well at night and how you protect your legacy. Trap 5. zoning could block rebuilding. You see an apartment block, solid rental income, good condition, great location. You assume if anything happens, I will just rebuild. But what if it's zoned commercial? That means you might not be allowed to rebuild it as residential. We saw this in Renberg. Fire hits, city blocked the rebuild. The investor lost everything, all because they didn't check the zoning before signing. Just because it's an apartment now doesn't mean you're allowed to rebuild one later. And that's where rookies get crushed. If your 5-unit block is valued at 2 million rand and you are denied rebuilding approval, that's not just a burden lost, it's a generational wealth erased overnight. That's how you can lose a whole burden, even if you had everything else right. If you want to see how I actually bought my first 5-unit apartment building without using the bank loan, I'll walk you through the whole system in the next video. Now, here is one last trap, and it's the one that hides inside deals that look the safest. Trap 6. Rent cap from subsidy programs. Ever heard of tax credit burdens, low price, reliable tenant, and government backing? But here is what many beginners miss. If a deal comes with rental subsidies like Section 42, your rent is capped. Let's say the market rent is 6,000 rand, but your cap is 4,200. Now, run that across 5 units. That's 9,000 rand a month, and that's over 100,000 rand per year in blocked income. These safe deals are often sold to beginners, but once you are in, you can't raise rent or grow. That's not investing, that's handcuffs. Know the terms before you sign. By the way, if you want to go deeper, I've put the full multi-family mastery playlist. It covers everything: buying, managing, profiting, all in one place. Most people only check the basics, but you are not most people. If you haven't yet subscribed to join the Legacy Builders, we've got more coming that you don't want to miss. Subscribe. And if you found this video valuable, hit the like button. And if you know someone buying their first property, do them a favor, share this video with them. You might save them from 100,000 rand mistake. Here's the full breakdown. Screenshot this, keep it close, and share it with someone who's buying soon. Because when it comes to due diligence, what you miss could cost you millions. Here's the full breakdown. Screenshot this. Due diligence done right save millions and builds generational wealth. You've seen how big these mistakes can get. If you want help avoiding them, reach out. Text due diligence to my WhatsApp number for a free strategy call. And don't forget to subscribe to join the Legacy Builder community. Be a Legacy Builder. See you in the next video. Peace.